Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul try to parse out blockchain, cryptocurrencies, and Bitcoin. One is a revolutionary technology. One can potentially change the world of banking, and one has dominated recent headlines. They first dig into the distinctions among these concepts. They then discuss whether Bitcoin is a store of value like gold or a speculative investment like a startup. But beware, if you are removing regulated institutions from the process, there is no one to help you find your lost keys if you misplace them. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. Today, Trish and I are going to talk about Bitcoin. This has been in the news a lot. We've seen it jump up dramatically a few years ago. Then we saw it drop a lot, and now it's up even more. And there's kind of so much going on that's starting to kind of come into news, starting to get questions. And so Trish and I want to kind of flesh out some of our thoughts and ideas on blockchain as a technology, cryptocurrencies, and Bitcoin specifically. So we are recording this on January 13th. And we actually had a conversation before we started recording of should we include the date, because we usually record it a few weeks before it goes out. And because so much can change between when we're recording now and when you're listening to this, we wanted you to have that context. So Trishul, today as of January 13th, what is Bitcoin currently at?
It's in the ballpark of $35,845 for one Bitcoin.
Okay. And so we have seen dramatic increases over the last year. And if you look at kind of charts of Bitcoin, we get like plus 1,000%, I think in 2017, if I remember correctly, and then a negative 80%, and then we're now up back over 1,000%, I think. Does that sound about right over the last few years?
Yeah, the percent numbers just kind of sound silly at that point. The stat I'm looking at now is from last year till now, it's up around 340%.
Okay. So it was 1,000% in 2017, a negative 80% for like 2017, 2018, and now it's only up 300% over the last 12 months.
Right.
Okay. So when you start to get questions about Bitcoin, I guess, so I think we need to separate out blockchain as a technology, cryptocurrencies, and Bitcoin specifically. When you get questions about Bitcoin and like kind of it's gone up so much, what are your initial thoughts on Bitcoin specifically?
With Bitcoin, what comes to mind is the notion that a lot of what you hear is how it's going to revolutionize how we spend money and how the demand is going to increase as more and more people adopt it. And that's where things get a little murky because, as you mentioned, there's a distinction between blockchain, which is the underlying technology that Bitcoin was built on top of, and then there's actual cryptocurrencies, which again sits on top of blockchain. These are just different types of currencies that could leverage the blockchain technology. And then Bitcoin is just one example of those cryptocurrencies. And it happens to be the one we hear about the most because it was the first one.
Okay, so, and I guess I'd say I tend to agree. I hear similar things of kind of lumping those together. That Bitcoin, cryptocurrency, and blockchain are an incredibly new technology. It's going to revolutionize the world. It's going to make banks obsolete, and you want to get it on the ground floor. But so maybe we do need to kind of start distinguishing that right now, and kind of from the beginning. We'll build back up to Bitcoin. So going back to blockchain, do you want to give us a quick primer on your understanding of how blockchain works? I think we've actually talked about this in the past, but let's revisit it.
Yeah, happy to. So blockchain, again, is just the underlying technology. And the central idea behind blockchain is this notion of a public ledger. And when you think about a ledger, with a bank, or if you have a small business, you might have a ledger for your business. All it really is a recording of transactions. But the tricky part with a set of transactions that are operated by a private entity like a bank is you kind of have to trust the bank on what they say is inside that ledger. And of course, it kind of gives up control. And if you ever want to see what's in there, you have to say, hey bank, what's in the ledger for the transactions that are related to, my bank account, for example. But with Bitcoin, or with blockchain in particular, the ledger is public. And what that means is everybody can see every single transaction. But more importantly, whenever a transaction is created, it gets added to this public ledger. And what that means is that public ledger is kind of replicated on all these different computers around the world. And then the great part about the ledger is to figure out what the true value is for a given transaction. Well, you can just look up that value across all the computers, and whichever value, or whichever value that all the computers agree upon, more than 50% of the computers agree upon, that's defined as the actual value of that ledger transaction. So the interesting notion here is that it's very hard to compromise this transaction because A, it's not stored at any one central place, country, or server. And, if you were able to, for example, hack into a particular server that's storing these ledgers and change a transaction, well, there'd be hundreds of other servers out there that you would also need to hack into. And that'd be quite hard because they're all over the place and they're all backed up and encrypted and so on. So that's why having this sort of public ledger is sensible. It gives up control to a centralized authority that could perhaps either be nefarious or under some sort of government control or manipulation. And the second key part about blockchain is the transactions can also provide anonymity. They can be encrypted when they're added into the ledger. And if you have the key, you can control that transaction, meaning if, for example, with Bitcoin, a transaction was Aaron, you sending me money, well, then I would get control of that transaction by having that particular access to that particular block in this whole blockchain. And that would be assigned to me because I have the key to unlock that block, but that block is still public information. The key is private to me. So it allows this ability for public transactions that can be also sent back and forth in a private manner. So combining these two is what the foundation of blockchain is all about.
Okay, so I no longer need to rely on a bank. If I want to send you money, either electronic ACH or writing you a check, I no longer need to have a bank verify that the funds are in my checking account, and then they actually transfer money from my checking account to your financial institution. I don't need to rely on that bank as that financial intermediary. We can use the kind of the coding of the blockchain and the transfer of that key you said, of all the computers agree I have enough money and I send you enough of a certain transaction. So we've created a transaction, you now have that key. So we have this, again, like you said, public because it's many computers, which provides the security that no single, my bank's computer can't be hacked. Or I guess my individual bank's computer could be hacked, but you can't hack all of the computers that have this record, and it goes directly to you rather than through a bank intermediary. Do I have a good understanding of that blockchain technology?
Yeah, and to add just a little bit nuance, probably it's probably important here to introduce the concept of the miners. We've all maybe heard about Bitcoin mining, and that's where the actual transactions and how they're maintained in the blockchain come into play. So the miners have two key responsibilities. One is they're responsible for creating new Bitcoins. And the second thing is they're responsible for adding transactions into the blockchain, and they get compensated for both. So for example, if you, Aaron, send me money, a miner will charge a transaction fee to place that transaction into the blockchain. And that's how one form of compensation happens. And at the same time, the miner can also be kind of enabling, through solving complex problems, the creation of new Bitcoins. So that's essentially how these coins also get created to begin with.
Okay, so it's a little bit of, these are the things that need to get contributed to, like if they're willing to provide their computer or server to be part of that public network, then they get compensated either through the Bitcoin creation or those small transaction fees.
Right. So this actual public ledger has every single transaction that's ever happened for any Bitcoin that's ever passed back and forth since the history of all the transactions, which goes back, I guess, a decade or so. Now, today, what that means is there's about $650 billion worth of Bitcoin out there based upon today's valuation. What that also means is there is about 18.5 million Bitcoins. Given that each Bitcoin, again, is worth about 35,000-ish, that's how you get the $650 billion mark. It's interesting to note that's around the valuations of the world's largest companies at this point. So it is a pretty sizable amount that is currently floating around in this type of currency.
Okay.
The other thing to realize also is that there is a cap on the amount of Bitcoins that will actually be created. It's baked into the code. So currently we're around 18.5, 18.6 million, and there will only be a total of 21 million ever created. So two things to note there is, once that cap gets reached, now there will no longer be new Bitcoins created, but also there won't be any additional income earned from the miners from actually mining the Bitcoins and creating new ones. All the income earned will be through transaction fees.
Okay. I feel like I'm not ready to deal with that issue yet, but that is good to know. Well, another kind of example maybe helps us understand the blockchain technology, because I don't want to talk about cryptocurrency and Bitcoin quite yet. We had mentioned, you had mentioned that the post office filed a patent for using blockchain for voting. I think this was a good conversation because it removes the blockchain technology part from the cryptocurrency and Bitcoin discussion. So do you have any either information, or could you kind of extrapolate how we could use blockchain to kind of trust voting for the president online?
Right. Yeah. So again, we mentioned this maybe around the election time, where it was actually put forward that the post office had filed a patent for this type of technology using blockchain to help voting. And it's a great idea from my perspective, because blockchain seems to accomplish two very important things that are required for voting: a audit trail, that's the public ledger, the ability to see what everybody voted for in terms of the outcomes, but also anonymity, meaning the ability to not be able to see or be able to hold private who you actually voted for. So it seems like this type of technology, blockchain, is quite perfect for what seems to be a pretty hard problem in society these days. That figuring out, who won an election, and how to make sure that it's fair and accountable and auditable.
I think that auditable perspective is probably the key. That we have all the transactions, and if you have kind of each individual voter maintains their key, and so the voter knows who they voted for, and it is verifiable if they were to say provide their key to some auditor if they wanted to give up that anonymity. But we don't necessarily need them to do that because we have this public ledger. And I think the key was it's stored on hundreds of, not thousands of servers across, and in this case, be across the US. Although actually, I guess international servers could be contributed to voting in the US. But it's across enough that we're not relying on that single company's voting machines per se, where there's been no evidence that I've seen that there has been any fraud, but theoretically, a single company's voting machines could be susceptible. Like we have that centralized source that we have to trust is working correctly, and we keep the paper trails and try and audit it by hand. So it is incredibly time consuming and requires significant man hours, but this could reduce those hours without giving up that security.
Yeah. So it certainly seems like a great application of the technology.
Okay, so Bitcoin, again, I tend to agree. I think that this really could be a revolutionary technology for the world moving forward as more and more things happen online, and as we kind of become more and more of a digital world, that having something that can provide that security that's kind of not hackable. And it's not hackable not because any individual server is secure enough. It's not hackable because there's so many servers. And that's what I think is kind of, I don't say the beauty of it, but what makes it dependable is that as long as each individual security is secure, each individual server is secure enough, then you do that enough times, and it's simply kind of too impractical that the majority, you can get over that 50% number to actually make any influence. And so that's why I do like it and trust it, and I think that there's probably going to be more applications moving forward that we can't imagine. But when it comes to the cryptocurrencies currently using that, here's where I start to have some concerns. So I know Bitcoin is the most popular cryptocurrency. I do know there's a variety of other cryptocurrencies, and I was wondering if you could speak to that a little bit, and kind of it, not just like they've all created different currencies, but like, are they functionally the same or different, or is it just kind of the same thing as Bitcoin, just has a different name?
Right. So the technology, starting with blockchain, is in fact open source. And what that means is the source code that underlies the technology is available for anybody to see and use and build upon, frankly. So you can take that technology for the blockchain and you can use it across these various applications. As we mentioned, you can use it if you're the Postal Service to create a voting application. You can use it to create a currency, as we mentioned with Bitcoin. And there's a few other reasons that are quite sensible. One reason I saw is anytime you have a contract between two parties, what happens these days is people sign a contract, they send each other copies and then hope nobody changes those copies. But in this case, you could have a public ledger of those contracts such that it's immutable. You can't go back and say, hey, wait, my copy says this, but your copy says that. At the same time, you can create a new coin. So you can take that source code and you can say, I want a new source code. I want it to have this name and I want it to have these parameters, meaning I don't want it to have a limit. I want them to increase in supply by this rate and whatever other parameters you want to throw into the development of this coin. And then you can launch it on your own and hope people adopt it and hope the price goes up. And
so you could create a new currency that didn't have a 21 million coin cap. You could create it with a different cap, or the mining rate is different. So you could kind of make slight changes to that code to fit what you're trying to accomplish.
Yeah. In fact, you can even say the value of this coin will be tied to the price of gold, right? Or the value of this coin will be tied to the US dollar, right? And it's interesting because another application of this is something known as a ICO. So we all know an IPO, an initial public offering, where if a company wants to raise money, they'll put shares out there and on an official exchange, and they have to go through a lot of hoops to get their company listed on the American Stock Exchange or the New York Stock Exchange or NASDAQ, something like that. However, you could make a coin, and have that coin be tied to the valuation of your company. And that's a way you could list your company on an exchange that basically trades Bitcoins. And the value of that coin would go up and down as your business does better or worse. So in fact, this is a novel approach that was quite popular maybe a handful of years ago, where companies, especially smaller companies, realize that if they want to go to market and raise capital, they don't need to go through all of the hoops that a traditional company might need to go through. In fact, for a fraction of the cost, they could just create a coin that represents the valuation of their business. So in fact, there are many applications for creating coins depending on how somebody wants to go about it.
My guess, and I want to get your thought as well, raising capital and costing significantly less sounds like most of the savings comes from bypassing SEC regulation on IPOs and new stocks.
Yeah, well, there's two major costs or hurdles. One is you probably need to go through the big banks, and they have to charge their commission, which can be a pretty hefty percentage of the actual valuation of the company to bring it to the public. What they're doing is they're helping you jump through all of those legal hoops.
Yeah.
But they're also getting investors on board with whatever your company is about so that they're more likely to kind of get in on the ground floor.
Okay, so it's not just the lawyers and regulatory hoops from the SEC, it's also bypassing the investment banks that actually go out and try and sell your stock. Like if you imagine a company that's going public 50 years ago or 100 years ago, that they're based in New York, but people outside of New York have just never actually heard of this company. It actually is a really good, successful company, but there's no internet to kind of spread the word for people to find out about it. So they need the investment bank and the employees of the bank to go out and actually sell the shares in this company, or in this case, would be trying to gather interest or commitments to buy the shares when they become public. And so by raising interest and finding buyers, the investment bank takes a commission, and that commission itself can be pretty substantial relative to the amount of capital you're raising. So we're bypassing regulations, but also bypassing that kind of investment bank commissions that it takes to raise capital, because of the internet, we no longer necessarily need to pay those investment banks the same level to go out and raise capital. The old-fashioned way, we can just put the word out online and see if people are interested in the company.
Right. So that there's a lot of pluses and minuses to this notion. Again, if it's not regulated, then it's kind of the wild, wild west if you think about it. Because, for example, within the US, to get listed, you actually have to provide a lot of information on what's going on with the company, including the financials, the risks, and the business plan, and all of that. And even then, it requires audits and also a substantial amount of transparency on a go forward basis. Whereas if this is an unregulated ICO, then in fact, it could be listed on a coin exchange that is quite outside of the US authority. So it definitely is a pretty gray area in terms of, is the company you're buying really, is it really there in fact, or is it actually doing what it says it's doing?
Yeah, like you said, the old Wild Wild West is like actually selling railroad stocks. Like, hey, we're going to build this new railroad that goes out west. We're just looking to raise money and looking to raise capital for the actual steel and construction. But then that railroad doesn't actually never actually gets built. And that this was one of the ways that kind of stockbrokers in the 1800s were really just flat out stealing from investors, and it was one of the many things that spurned the creation of the SEC. And so by trying to bypass that regulations, like you said, we're going exactly back to that. You could be buying the coin of a company that is an address and a room with a bunch of phones, but there's no actual clients or customers or revenue or product. There's no way to actually verify that unless they go through some kind of regulatory review or those going through those hoops that they're trying to avoid in the first place.
Yeah, that's right. And that kind of ties back to, okay, now what do we think of Bitcoin? Because what this kind of reminds me of is just how things were going with the dot-com boom. And what happened around that time is we had this new technology, we had the internet, and everybody kind of realized, okay, this is going to stick around. It's going to revolutionize things. And pretty much any company that could put a .com behind their name was having an IPO with almost no business model and certainly no earnings or profit, maybe revenue, maybe not even. Yet they were raising billions and billions of dollars, and random stocks were just going through the roof. We kind of saw this again a couple of years ago when Bitcoin had its first major boom, and we had ICOs popping up. We had other cryptocurrencies popping up left and right. And I think what was true back then with the dot-com boom is probably true today. The technology will likely stick around, will likely revolutionize things. And in a decade or two, we'll probably be in a position where we can't imagine ourselves, without broadband or without cryptocurrencies a decade or two from now. But that doesn't mean any cryptocurrency or any dot-com stock that we bought 10, 20 years ago, or 22 years ago would have any value today.
Okay, so I think this is a really good transition. So cryptocurrencies themselves, it's kind of, I like the .com comparison, because people think of the cryptocurrencies like other exchange traded security, not even securities, but exchange traded items, most commonly something like gold or other commodities. That's kind of the closest comparison, where because it has volatility, we have data, if you look at a chart, it looks like the chart of a stock. But with a cryptocurrency, and now we're getting kind of different economies of how currencies work. With a cryptocurrency, there's no revenues, there's no product, there's no service that they're offering. They're trying to hope to be a store of value that if you buy it now, it'll be worth more in the future. Someone else will pay you more for it. And from that perspective, it's actually very similar to gold. That gold doesn't generate revenue, doesn't have a product, doesn't have a service, isn't trying. it doesn't have a way to kind of grow its market cap. It's just, I have gold. I'm hoping someone else in the future will pay me more for it than I'm paying now. And gold has actually held its store of value relatively well over a long enough time frame. And by long enough time frame, I'm thinking centuries or millennia. So from that perspective, I can see a cryptocurrency maybe working as a store of value. The concern is it is unlikely that all cryptocurrencies will maintain a store of value. Similar to how the US dollar is the world's reserve currency. So I've used the example of when France wants to buy oil from Saudi Arabia, they pay in US dollars. And that's just a quick example. That's what it means to become the world reserve currency, that US dollar is stable enough to allow international transactions. It is possible that Bitcoin specifically, I think, reaches that level. And here we need to kind of introduce the phrase of a fiat currency. The US dollar is no longer on the gold standard. There's no longer gold sitting in Fort Knox that's backing the value of each dollar out in circulation. It is a fiat currency where everyone agrees what a dollar is worth, and that provides the value. It's that almost like the networking effect you see with Facebook, and its only value is that everyone agrees it has value. That Facebook only works because everyone's already using it. That's why it's hard to create a new social media, because it doesn't take off until everyone's also using it. So we have the fiat currency idea where everyone agrees a dollar is worth a dollar, and that provides its value. Other currencies have done well. So British pound, Chinese yuan, Japanese yen are similar. They're also backed by a central bank, so there's some control there. Other currencies around the world have not done as well, and so that's where you see things like hyperinflation in some countries. The euro is having issues in part because you have different countries with different tax systems, different economies, all trying to use this single currency, and so that creates some problems, but it still has some of the characteristics of that fiat currency. So because this is more my guess, because Bitcoin has the name and the popularity, it's possible that Bitcoin does become that fiat currency that everyone kind of agrees what it's worth. Other cryptocurrencies probably not, because it's going to have to get enough people all buying in. It just hasn't shown to have that same level of demand or characteristics. It's possible it's just because Bitcoin, I think they were the first. I don't know for sure, but they might just be the Kleenex of tissues. First. Yeah, but they're the Xerox of copy machines, that kind of thing, where the name itself has become synonymous with the underlying product, service, device, etc. And so I can see Bitcoin getting there, but going back to that store of value idea, we haven't seen enough to trust that yet. It's because it has gone up so much at different times and has shown so much volatility, both up and down. I at this point definitely don't trust it as a store of value. And so I'm curious to kind of get your thoughts on this idea of, we've talked about blockchain, we've talked about cryptocurrencies, but Bitcoin specifically as either a store of value, either a fiat currency, or kind of the volatility it displays.
I think at a high level, I largely agree with the points that you made, Aaron. I think just to build upon a couple of things, as you had mentioned, you can kind of think of Bitcoin as a currency, or a fiat currency to be more specific, where its value is purely determined by just supply and demand. And the way I kind of see that demand coming up is from two perspectives. One is Bitcoin does have utility. You can use it to make transactions. So from that perspective, as long as it's useful, it might have some value to people who are able to use it. And the second perspective where its demand kind of comes from is frankly from a perspective of speculation, meaning a lot of people are demanding it because they think other people will demand it more in the future because a lot of people are demanding it. What that essentially boils down to is what we kind of look for in, or what we term in behavioral finance, the greater fool theory, meaning I know that the value is supported by people trying to rush in a bubble, but I'm going to be the one who, sells it to a greater fool before everybody else runs for the exits. So I think, there's one good reason why, or the first reason is certainly sensible on why somebody may want to have Bitcoin. It has utility. It may be helpful to, keep value that's not controlled by a government, that can't be inflated away, and to be able to preserve that value over time. However, the second reason, which may have a pretty strong impact on its price, in terms of everybody rushing in to buy it simply because they think it's going up, that may not be the best long-term place to store your wealth if you're thinking about it from an investment perspective. So I think that's where this kind of comes down to in terms of a distinction. Are you holding Bitcoin to store value and use it for its utility, or are you using it from an investment perspective? And I think you made a very good distinction in terms of an investment perspective, where a distinction that is sensible for investments is that there are two buckets. One is you're buying a percentage of an asset that's intended to make money over time by producing things. That's typically what happens when you invest in a company. You're putting your money to work, and that money is being used by the company to make more money. Whereas with Bitcoin, it's more of a speculation, meaning that money goes into Bitcoin, but Bitcoin doesn't take that money and build new buildings or new cars or new robots. It just ends up sitting there and increasing in value because more people, others will pay more for it in the future. So that there's a big distinction there. And frankly, I think from an investment perspective, it's sensible to store capital in assets that produce value over time, like businesses and stocks.
Yeah, I can see getting to a point where Bitcoin kind of works similar to gold, where again, either has that utility, like you talked about, or even it allows better, safer online transactions, something like that. I can see getting to that point, but as a speculative investment, like you said, it's just it's that. What was the theory of the greater fool?
The greater fool theory.
The greater fool theory. Like that's what it feels like right now. It's just the people aren't buying Bitcoin as like, oh, it's going to hold value through the pandemic, and as the Fed is increasing its balance sheet, it's just, oh no, it's going up a ton. I want to ride up. I want to get the ride up. And from that perspective, it does feel like the .com era of, oh, you can sell stuff online. I'm going to buy every IPO of a company that sells stuff online. It's like, but they're not, like, yes, they can sell stuff online. They're not actually selling stuff. They don't have profits that you like to see from a company that rewards stockholders. And so the reasons why people are buying it now are not the reasons why I can see it becoming viable down the road.
Yeah, I agree. I'm thinking about a Warren Buffett quote, but I'm not sure if this is even right. But I recall a quote going something like this: the stupidest reason in the world to buy a stock is because it's going up. And if that's the reason why an investment decision is made for Bitcoin, it's likely to not end well. And the reason I say that is, here's an actual quote by Buffett, which kind of aligns with all what we're saying. When you're investing this type of instrument, you're just hoping the next guy pays more.
Mm-hmm.
And if you feel you'll find the next guy to pay more, that'll only happen if he thinks he can find someone that's going to pay more than that amount that he paid. So at the end of the day, you're not really investing. You're just speculating on that happening.
Yeah. It's between the lack of like the ICOs and kind of the lack of regulation, it does feel like the Wild Wild West. And I think some people are going to really work out well, but there's just so many risks. And I don't see the corresponding rewards per se. Like it could happen. But it feels like the risks are too high. There's a story I've seen circulating about someone who bought Bitcoin. They didn't want to store it at a reserve, so they wanted to keep it in, I think it's their digital wallet. I forget the exact phrasing and nomenclature, and then forgot their password. And so now they have 10 tries and they have 2 tries left, and something like hundreds of millions of dollars now. But this is the downside of all of those other things that Bitcoin and cryptocurrencies is trying to create. There is no central bank. There is no institution who can use kind of common sense to verify your identity or a person you know and trust. Like, yes, this is their account. It's just that code. And if you get locked out, I believe you're locked out forever. I don't know enough about the internal workings of that. Those coins just sit there forever and never get used or spent. So that's like, when you think of opening up a checking account, forgetting your password and losing millions of dollars doesn't seem like a realistic risk. But it is with some of the Bitcoin specifically.
Yeah, that is true. If you lose those private keys, then it's pretty much impossible to get them back. It's trying to reconstruct, like a 30-digit random sequence of numbers without having any information is almost impossible, or I guess statistically impossible. But I think at the same time, I want to key into a point you made, that there's always going to be that story of, that person who either hopped in when it was very low and somehow, held on to it until now, or if they had just done X, Y, or Z, that they would have been owning the rest of the country. And I think that just opens up a lot of behavioral biases that can creep up around these types of events. Frankly, I think it kind of ties back to the FOMO gene, where humans are inherently wired to just not want to miss out on things. And they really key into these stories that pop up here and there. Whereas if you look at the full breadth of data, you realize that it's quite likely that, that person who actually had the 500 Bitcoins from, 10 years ago or whatnot, and held on to them now, is so statistically unlikely. You're better off winning the lottery. Whereas there have been so many people along the way who, maybe they got out when Bitcoin was at 1,000. Maybe they bought in when it was at, 500 and sold when it was at, 1,500. But it's very rare that somebody's timed it so well that they got in and got out, such that, they put a significant amount of their wealth in hand, such that you compare their overall portfolio, all of their money together, that they're kind of doing better than they would with a more well-rounded investment strategy.
Yeah. It's I think so. The company I use SEI as the custodian, and I really like their platform. They put out a really good article that I like, and it kind of does what you're talking about. That as a speculative investment, it's really speculative. So like they're not inherently opposed to it, but if you're putting together an asset allocation because you want you to kind of depend on your money to grow well enough to achieve some lifestyle that you want, that it kind of, for a lot of my clients, the big question is they have money in company stock, usually through stock options or RSUs. Do we hold on to that company stock, which is high risk, high reward, or do we reduce that risk by going to a diversified asset allocation? Just as soon as we sell out of that one stock, adding other asset classes reduces our risk, reduces the potential upside, but increases the likelihood of achieving the lifestyle they want. I think that's the key, is that the single company stock is high risk, high reward. Cryptocurrencies feel like they're so much farther out on that high risk, high reward perspective. It's definitely not dependable on achieving anything in your lifestyle. There's no way if you were to try to think about, okay, what's our expected return for Bitcoin over the next 10 years? It's only been around 10 years, but it's okay. It's averaged 100% with 200% volatility. It's something like that. And there's no way to depend on Bitcoin as an asset for anything related to financial planning or your lifestyle. And it's like, yeah, like you said, it's like buying a lottery ticket almost, where it's like, okay, yeah, I have no problem if my clients want to spend money on lottery tickets. It gets over 400 million. I think it's actually up around 500 or 600 million, depending on which one you look at. And my wife and I enjoy the conversations on our walks of what would we do if we won the lottery? Because it's also like, just these are our dreams. This is just kind of what we like to do. So I have no problem if clients want to buy those lottery tickets, as long as they're not spending too much. They can't impact the amount that they're saving. But there's no way we're depending on this to achieve our long-term financial goals. That's just saving into a diversified portfolio of stocks. It's the boring, old-fashioned, just buy the S&P 500 ETF, buy the Vanguard Total Stock Market Index Fund. It's something like that. And for me, it's like I would almost rather a client say, hey, I know it's risky, but I'd rather buy into this particular company because I like their product. It goes back to like one of our first few conversations about buying stocks for fun. That seems more viable to me as a successful strategy than, oh, I think Bitcoin's going to 50,000. Like, really? Why? I don't know. Because that's the way it's going up.
Yeah, I largely agree with that. And I think putting some guardrails on an allocation, if a client is so inclined, it is probably sensible. And as we talked about with stocks, for example, if somebody wants to actively manage a certain segment, something that I recommend is for the bulk of the portfolio, I'm largely in favor of a globally diversified portfolio of stocks and bonds that are passive in nature. But again, going back to that conversation many eons ago, having a certain subset of one's wealth in a portfolio for speculative nature might make sense, and then a subset of that might make sense for Bitcoin if it falls into that kind of that lottery ticket bucket.
Yeah, yeah. But again, I'd rather buy a stock in Apple because I like my AirPods.
Yeah, at least you own a percentage of a company.
Yeah, exactly. Exactly. I I it's just one of those things, like I can't, you know what? I think is I can't see any fundamental reason why it's going up the way it is. And I think that comes to is one of those things I learned from, I think, statistics, maybe is data mining. It's like if you're looking through a large amount of data to try and find some correlations or some predictability, you'll find something. You'll find something that satisfies a p-value under 0.05 or whatever. Like you have a 95+% confidence that this is the case. And I've seen that applied to things like shark attacks predicting who wins the presidency. Like if you look at a large enough sample of just random data, you can find some kind of correlation to that. And the way you fight data mining is making sure that there's a logical reason for one thing to infer the other. That you don't go data mining, you put together a hypothesis and test that hypothesis. Like you have a logical reason why this might work, and then you test it and it does work, doesn't work. So like you have to keep kind of trying these different logical hypotheses, and that's how you can get better inferences from your data. That's kind of what this feels like with Bitcoin. I can't figure out the logical reason why it's going to 30,000. And I don't know that anyone else knows either. I don't know anyone else who has a logical reason why it's going to 30,000.
Yeah, I agree. I agree.
Sorry, I'm getting myself all worked up about this. Okay, I'm calmer now. Okay, so is there anything else that you can think of as it comes to blockchain, cryptocurrencies, Bitcoin that you want to make sure we share today?
I think we covered a lot of ground. I think I'll just end with also the notion that the U.S. government used to be a bit reluctant about this, but I think they also realized they can tax this, so they're a little less reluctant now. And so it's probably important to realize that gains on Bitcoin is actually treated as gains on property, meaning you would be responsible for paying capital gains on any movement. And what that also means is you have to think about your short term and long term and how that means in terms of gains and losses. So just something to keep in mind. The brokers that you deal with, likely they're required to go through some sort of know your customer and some sort of regulation where they're tracking back the transactions to an individual person if you're a US citizen. So it's quite likely that it won't be completely anonymous as one might infer based upon how the technology could be used. So it is something to keep in mind. Also, that does mean that during tax time, you should be getting 1099s and whatnot for these types of transactions. So also keep that in mind if you're dealing with Bitcoin.
Yeah,
At the
I remember
same time, yep.
in 2017, it went up. It was like the first time it went up a lot. People sold their Bitcoin and maybe bought a different cryptocurrency because that's kind of when more and more cryptocurrencies are being created coming out. They want to kind of get in on the ground floor of the next cryptocurrency. Then they went down dramatically, and so they didn't realize they actually triggered a capital gain by selling the Bitcoin. But when they got their tax bill the following spring, the currencies had come down so much, including Bitcoin, they didn't have the money to pay their tax bill. That they had to use outside assets to pay this significantly large tax bill related to selling at the end of 2017.
Yeah, I can imagine that can be tricky. Even if once we get to the point where you can pay for that pizza with cryptocurrency, it's kind of annoying that you now just made a taxable event for putting extra pepperoni on your pie.
I can see if the technology like gets advanced enough or easy enough that every online retailer that will accept Bitcoin will also have a capital gains estimator for you.
Yeah, and then you have to give them your cost basis and your time period, and I'm sure that the mess will provide enough productivity for others to capitalize on.
Yeah, it's again, I think that we're too early, and it's still the wild, wild west here, and I don't want to buy railroad stocks in 1850.
Well, good stuff, Aaron. I'm glad we had this conversation.
Yeah, I really got worked up more than I expected to, but I'm calmer now. So thank you very much for going deeper into this with me, Trishul.
All good, and thanks everybody for listening. If you're enjoying these conversations, do spread the word.
Thanks. Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.